There we go. Hey everyone, this is Josh Fraser with Origin Protocol, and I'm here with you, Evgeny. And we're going to be talking today about his fund, RP7 Capital, and particularly how they are thinking about OUSD and using OUSD as one of their investment strategies. Evgeny, how's it going?
Good, and thanks, George, for having me. It's a late evening in Paris at the blockchain conference, so it's a fun day, and it's good to talk about real DeFi stuff.
Yeah, it's great. Thank you for making time out of the conference schedule to do this chat with me. I know conferences events are always crazy, so thank you.
My pleasure.
So why don't we start with a little bit of background on you? How did RP7 Capital come to be? But more specifically, like what was your personal background?
Yeah, I've for my sins, I spent about 10 years in traditional finance, managing investments in hedge funds and banking. At some point when I was too bored and I couldn't stand the real work, I started learning about crypto. Then I joined an enterprise blockchain startup, and then when DeFi kind of started to emerge, it was obvious that it was impossible to stay on the sidelines anymore. And for the last couple of years, I've been playing in the space basically 24/7. And with my partners, we launched RP7 about a year ago, which is a DeFi liquidity fund. So we, every second person, I would say 90% of the space are VCs and 10% of people who are raising, money from them. So we thought that the ratio is a bit too crazy. And instead, what we're doing is, we're trying to help teams grow by using them, by providing liquidity and giving our investors, some yields in return.
And how do you think of obviously when investors are thinking about places to park their capital, what is it that brings them to RP7 versus other places, and like where do you try and differentiate versus other places people could go?
It's a good question, because even trying to explain what a DeFi fund does is is quite tricky. So obviously none of this is investment advice. That goes without saying. But we personally feel that DeFi is really, really unique in terms of, there are some places in the world where you cannot invest because it's, you may not know the language, you may not understand some nuances, you may not be big enough or whatever. DeFi, it's really difficult to understand, but once you understand it, it's open to anyone. Whether you're dealing with, $20 or very large amounts of capital, it doesn't really matter. Everyone has the same equal opportunities. And the gap is kind of technological and kind of expertise. So we specialize in DeFi very, very deeply. As you know, we've studied hundreds of protocols over the last year, or several years actually. And once you actually understand how DeFi works, then it's not as risky as it seems to the outsider, which is always the case. And we just charm them with our expertise. But most importantly, jokes aside, when the financial sector emerges, there is this period of excitement/chaos where a lot of things are happening. And if you don't know what's going on and you don't have the expertise, you can't participate. But if you can, a lot of opportunities open themselves up for you.
Yeah, I love the permissionless nature of DeFi, that anyone can play by the same rules and has the same access to opportunity as anyone else. I think a lot of times the best opportunities in life come from mispriced risk, and
Exactly.
smart contracts seem like these really dangerous, risky things.
Yeah.
And it can be, right? There's lots of rug pulls, there's lots of ways you can get burned. But once you actually build that knowledge base, you understand what those risks are, what the steps you can take to protect yourself, whether it's doing your due diligence, looking at the audits, understanding the code and the economic incentives and the economic levers that are at play, you can actually be quite safe, and you're at least taking on different kinds of risks than you would be in traditional finance system, where you're taking on smart contract risk versus counterparty risk or things like that.
I think that's spot on.
So tell me more. You asked a question.
Yeah,
you ask a question like, what is a DeFi fund? Let me throw that back to you. What does that mean? Does that mean that you're buying uni tokens and comp tokens, or what exactly are you investing in?
Yeah, I think you phrased it perfectly. What we're trying to do is we're trying to find mispriced smart contract risk effectively. That's what it is, right? So you phrased it very, very well, that it's all about the mispricing and the spreads that you're getting, right? So we have formed this knowledge of smart contracts in the space, teams in the space, and projects out there. So our job is to be market neutral. So we don't buy uni or comp tokens. We predominantly work with stable coins. And because the value proposition to our investors is that they can benefit from the yields in the DeFi space without taking on the volatility risk, right? So whether the market is down 70% or up 70%, in an ideal world, we should just be clipping our yield every single month and be completely agnostic. So it's a little bit like a fixed income product rather than equities or crypto for it, you know.
Yeah, and I have to imagine there's enormous demand for that. I was talking to the CFO of a publicly traded company the other day, and we're not quite ready to follow Michael Saylor and YOLO into Bitcoin, but they're certainly looking at DeFi, and you can offer 14-15% APYs in DeFi. He doesn't have anywhere else to get that kind of yield, and so he's looking to crypto, saying, how can I come into the space? How can I get access to that? And I think we forget sometimes, because we're so deep in crypto, that the yields you get in DeFi are mind blowing to people who are in traditional finance. It doesn't compare, and we're used to these crazy yields in crypto land, but to normal people, where just being able to get double digits on your stable coins is huge.
That's right. We're very spoiled in DeFi, but you're getting 10+% return without the price risk and with no lockups is actually amazing.
So who are the investors in your fund? Like, what type of people are invested?
It's a very wide range of people. We only deal with professional investors, so we have venture funds who park their spare cash with us. We have crypto businesses who need to again get yield on their cash. Obviously, family offices, fund of funds, hedge funds. It's a very wide group of people who are learning more and more about stable coins. And we've heard a lot of, I'm not sure if you've seen this, there is new proposal for regulation coming out of the UK, which is where we operate out of, where the government is basically saying, let's actually regulate stablecoins properly as a method of payment. Let's make it like almost illegal tender. And a lot of people reached out back to us saying, actually, a lot of our concerns were around, will the government prohibit stable coins because it's kind of against the government control? And now they're all realizing, actually, it's a very valid instrument, and we should really get on this train before it's too late.
Yeah, for sure. And today, more value is transferred over Tether than Bitcoin. And I think, it just speaks to the demand for stablecoins. You get all of the benefits of cryptocurrency in that you have, it doesn't close at 5 p.m. It's not closed on the weekends. You're not paying, crazy wiring fees to do it. You don't have to fill out any paperwork or talk to anyone to move your money around. It's online 24/7, always accessible and available in every country in the world. And at Origin, we pay our some of our employees in crypto. We pay vendors in crypto, and a lot. Most of the time we're using stable coins, and they're just really, really convenient. So I think digital money is here to stay. There's absolutely no question in my mind, and it's just a matter of how long it's going to take for governments and regulators to accept that fate. But it is that is unchangeable at this point.
For sure. And it's probably worth mentioning that, not all stable coins are created equal, right? So, I think kind of the way how we think of it as a firm is that we run the smart contract risk, but we also run the stable coin risk, because, you're not exactly getting a dollar, right? You're getting a digital version of that, and you really need to understand how that specific coin is issued, right? What is the mechanism? Who is the team? What are the reserves? How does the mechanism work? Because we've seen cases where, some of the stable coins aren't as stable as they're supposed to be. So a big part of our due diligence is actually picking the stable coins where we personally feel comfortable with, keeping our assets there.
Yeah. How would you categorize the different types of stable coins, and what are the sort of different risk profiles whether it's counterparty risk with something like Tether USDC versus mechanism risk with something like UST or something like that. But I'd love to hear kind of how you think about it and the risks.
Yeah, I guess we kind of think of it, you have the centralized bucket and the decentralized bucket, right? So technically, Circle or Tether have the power to freeze coins in any specific wallet, right? That's what they can do.
It's crazy, isn't it? Yeah, it's crazy.
It's pretty scary. So obviously, as long as you're not doing anything wrong, then you should be. There is no reason why you should be affected by that. But it's a lot of power to be held by one entity. And then you have decentralized stablecoins. DAI, I believe, to be the oldest of them. And then we have, the whole spectrum of, let's not name the ones that, collapsed a few weeks ago. So yeah, you have this whole range where some stablecoins are backed one-to-one by, let's say, other stablecoins. And these are amazing, obviously. You have some which are over collateralized, DAI being one of them. And then you have algorithmic with various designs, Frax, UST, and many others are algorithmic. This is probably the trickiest bucket to get right. A lot of them historically suffered horrible fates where, within days or weeks, they went basically to zero. So these are the trickiest ones. We, on average, we hold, I believe, about 12, 13 stable coins at any point in time in terms of that we spread. And we even source insurance on them from time to time. So we're kind of very thoughtful about allocating and sizing up our positions. Because, yeah, they're not, every mechanism is unique and you're getting very different types of risks.
And so are you intentionally holding so many stablecoins from a diversification perspective, or because you need to hold that many to get access to the kind of yields that you're chasing?
It's a bit of both. So we don't diversify for the sake of diversification. If we feel comfortable with the specific stablecoin and there is somewhere where we can put it, then we'll go for it. So it just so ends up happening that we're spreading ourselves across a relatively wide range. But to be honest with you, you still end up being concentrated in quite a few because there is obviously one very unique case where you don't need to put stablecoin anywhere to generate the yield, and I'm sure we'll get to this. But most of them you need to spread out, and yeah, you just have to kind of find out where they can be deposited, and then you kind of chase that opportunity.
Yeah, and we'll get to Origin Dollar and why you chose to use that. But first, I want to ask, what worries you the most as an investor investing in stablecoins, different earning opportunities? What keeps you up at night? What is the disaster scenario that you're most want to prevent from occurring?
Well, thanks for bringing it up. Late evening my time, so I'll have some nightmares today. But I mean, in all seriousness, probably the scariest part is obviously it still remains a smart contract risk, right? So we approach it very much like a credit risk, right? So when you give a child a financial statement, the child will not be able to analyze it. If you give it to a professional, they can with confidence say, yeah, this company is about to go bust, in a week, in a year, or maybe never. With smart contracts, it's much, much harder, where you have, the best brains of our industry missing things, and that just happens. So we've taken kind of a risk-based approach where we have, our portfolio spread out across, 30 different platforms at any point in time. The size of the position depends on our level of confidence in a specific platform. We source insurance to protect ourselves even further, but we learn to, it's not the risk we can fully control. So we can do our best to mitigate it, but we can't say, this will never happen to us, because who knows? So this is still a little bit, you need to learn to accept it. And it wasn't easy to kind of living with that mentality where, you can go to sleep and then, some horrible hackers do something very, very nasty. But if you think about it from a statistical, mathematical, and probabilistic perspective, then actually there's nothing to worry about, because, I mean, what's the DeFi, assets right now? 200-300 billion. It depends, varies on the day.
Depends on the day, yeah.
Exactly. How many billions have been stolen? Less than 5, if I'm not mistaken. If we're, generous, probably even less. So 2%. over 2 years, well, 3 years, that's not a bad default rate if you think about it from a traditional
Right.
standpoint, right? So mathematically it makes sense, but when you can't control a risk, it's hard to let it go.
Yeah. Well, a lot of the money has been aggregated into a few protocols that are de facto trusted at this point.
Sure.
If something like Maker is found to have a fatal flaw in it, the repercussions of that are going to be felt,
Yeah, that's
very
right.
wide and far. Yeah.
But yeah, funds like us, we have to position even for those scenarios, right? So that even if the worst happens, we should still be able to survive it, which is, yeah, it forces you to think about a lot of different things.
Yeah, no, it's really smart. I think one of the things that's really interesting about space is how often you have to think about risk management,
Yeah,
and what are the different points of failure, and where can things go wrong? Whether it's, is a bridge going to get hacked? Is this volatile asset, this backing this asset, is it at risk of blowing up? Is my software wallet, hardware wallet, going to get hacked? I mean, there's just so many different things and
yeah,
different layers that you really need to think about and protect yourself at.
exactly. That's exactly right. But money management is about risk management.
Yeah.
It's easy not to think about risk when you're hoping to make 100x return, but when you're doing something a bit more kind of traditional in terms of portfolio management, then it's all about risk management.
Yeah, I think especially for stablecoin farmers, because if you're trying to get 10-20% yield,
Yeah.
it doesn't make sense to gamble your principal for that little, right?
Yeah.
In an investment style fund, you're willing to gamble 100% of your principal for a chance at 100x or 1000x or some crazy
Exactly.
return. So it's a different kind of model.
Exactly. That's exactly right.
Yeah. So tell me more about your typical yield farming experience, and then maybe compare and contrast that to Origin Dollar. But I would love to hear, just first of all, like sort of the pain points that you feel farming other coins, and what that typically looks like for you.
Yeah, so we, due to the fact that we are diversified across dozens of platforms, and due to the fact that we have researched hundreds of them over the last couple of years, we have to track all of that data, which is basically impossible to do manually. So we had to build our own proprietary infrastructure where we are in real time connected to the smart contracts of dozens of platforms on different chains. And it makes it a little bit easier because, I get an alert saying, yield here was 5%, now it's 25%, so maybe you should move. So the complexity is around managing all of that, which is why we have a proper team doing that full time. It's not very easy to do that. And the typical journey is, you see that the yield somewhere is becoming more attractive on a risk adjusted basis. So you take your money from somewhere else, you have to unstake it, remove liquidity, maybe bridge it, and then do kind of, so you're doing 7 to 10 transactions if you count the approval ones, and it's just a lot of work. And then on top of that, as you well know, a lot of the platforms, they basically subsidize their growth by giving you their tokens as rewards, which is great, and that's how we this is what pays the bills basically. But then you're exposed to the volatility of that specific token. So maybe there is, Avalanche Rush, Polygon rewards, or whatever. So then you might be exposed to the token of that ecosystem. So we have to have a view on these assets, and it's impossible to get them right all the time. So the problem that we sometimes have is that, we position ourselves for a yield which we believe to be good, but then the yield just, drops out. Because something fundamentally changed with the, let's take Phantom, right? You could be earning some nice Phantom rewards, and then, Andre decides to leave the industry, and then the token goes down. So you can't really model that. And it's annoying because you incur transaction costs when you move and you deploy, and then you have to move out and redeploy, and it's just churning your capital. So I assume most of our users will be familiar with Origin, but OUSDs, we found to be pretty unique and pretty awesome because we don't need to deposit it anywhere. We can if we want to, but even if it just sits in our wallet, it generates yield. And at the end of the day, we started with one coin, and a year later we have 1.15 or 1.20 or whatever, and which it just sits there. So it makes it very easy because If you want to get out, fine, go to Curve and sell it. You want to take that coin and you want to put it into a Curve pool or somewhere else, fine, you can go and do that. So this reduces the transaction costs. This removes one layer of smart contract risk, because no matter which stablecoin you use, maybe with the exception of USD and USDC, obviously, so USDT and USDC, you're taking their smart contract risk plus the risk of the platform where you put it in. So you 2x the risk to get your yield, and 3x the complexity. And here is the opposite. So it's very cool. And there is like a trick that we're probably sharing, but anyway, you can obviously, there is a mechanism, as you very well know, that defines what yield goes to those who just hold it as cash in their wallets. And if you monitor that, then you can be quite active, because when the ratio is in your favor, you just take OUSDC out of Curve and you put it in your wallet, and when it goes the other way, you go the other way. So that's pretty interesting, because I don't think there's any other stablecoin that just grows in value as you keep it in your wallet.
Yeah, and this was really born, OUSD was born out of feeling the pain of yield farming ourselves, especially on Ethereum, right? When the network gets crazy, and it will, not uncommon at all to spend $100, $200 on each time you have to maintain one of your positions. And for me, it was getting really, really tired of staking my funds, having to come back, claim my reward tokens, go to Uniswap, swap those rewards tokens for stablecoins, come back, restake those stablecoins, and then trying to repeat that every couple of days so that I get compounding interest. And unless you're a mega whale, the economics start to break down, right?
Yeah.
And I remember going through this process, feeling like I'd made all this money, and then I sat down with an Excel spreadsheet and realized that all this work I'd done was a complete wash because of all the gas fees that I'd spent to earn the yield. Even though it was this crazy high percentage that was advertised, it just wasn't enough. And so Origin Dollar is really it's built on, inspired by multiple different things that we put together in a novel way that hadn't been done before. Obviously, things like Yearn vaults exist, where you can just deposit your money, you amortize the cost of maintaining that pool and that position over time, and you can share it. Everyone who's coming in and out of the pool can share the workload of harvesting the rewards and compounding them. We've also seen other things like Ampleforth, which was first rebasing token I ever saw, which is a different mechanism where instead of having a set number of units where the price of those units goes up or down, like volatile assets we're used to, you have a fixed price of $1, but then you get additional units in your wallet. And so we'd seen Ampleforth, of course. Theirs would rebase in both directions, right, up and down. So you'll either get like way more money in your wallet, or it'll disappear, and you'll be like, where did it go? But that was the first time we were like, oh wow, we can actually we can use this technology to just have a more convenient way of distributing the yield to the users. And so we put those two ideas together of, what if we had a Yearn vault wrapped in a token, in a rebasing token, and made it so that it only rebases up, and then you can just hold it in your wallet, and you can get all of the benefits from all of the other participants who are coming in and out of the pool. They can, we can share the work involved in maintaining the pool, and we can all save on gas costs and all the headache of having to manage this.
Yeah, which is quite a differentiated value proposition, because you don't really have this anywhere else right now.
Yeah, it's somewhat surprising to me that we haven't seen really any knockoffs or clones of other people trying this. For us, we think it's super useful. Myself as I hold a lot of OUSD myself, because it's just so much more convenient than any of the other things I used to do when I was yield farming.
Yeah, the only thing you need to keep in mind is, just in case you need to revoke the approvals, just to be safe. But otherwise, it's so much easier and safer.
Yeah, So you were hinting at the trick that OUSD has, but you're taking advantage of. Maybe explain that a little bit more on what that trick is and what's so unique about it.
Yeah, it's so now, yeah, you forced me to give up all of my, all of my alpha. I have to work twice as hard now. But because it's the mechanism is pretty interesting, right? Because the token is rebasing, but it's, and forgive if I butcher the technicalities, but if you basically take your OUSD and you put into Curve and you stake Curve into Convex to get the boosted yields, then you're giving that rebasing up, because Curve does not support rebasing tokens, if I remember correctly. So then what happens, you have this OUSD pool which earned all of this interest, and all of this interest is supposed to go to everyone who is rebasing. So if you have half of the people who are rebasing and half of them are not, then half the people are getting all of the rewards, which means they're actually 2xing their yield. So we've seen cases which just shows you how well you can do in the space if you actually track the data. So my team have built, real-time kind of connectivity, and we're basically quantify that ratio, and that ratio helps us understand whether too many people gave up their OUSD rebasing and they're making good results with CRV CVX rewards, and then we're just making basically much higher rewards on our cash than what we are across the average for our portfolio. So that's a really neat trick, and over time we've seen it became a bit more balanced. So I guess we're not the only ones kind of looking at that, but I feel that more and more people should pay attention to that, because it will make the market much more efficient, right?
Yeah.
Because
Yeah.
the peg is more tightly maintained. It's tight anyway, but even tighter. And then it saves everyone the transaction cost, because then technically the reward should be either at par, or the market should say, well, you're taking OUSD, you're putting it somewhere else. There is a tiny, Curve. We believe for Curve to be, the AAA kind of product of this industry, obviously. But technically it's still another complexity. So maybe that should yield you like a little bit more, but maybe not. And the market will kind of decide. And that's a very neat trick, because it's just so, honestly, it's just so easy, especially when it's a regulated fund. We have to do like audited statements to our investors. So it's so much easier to show, what you have in your wallet than to, dig through the smart contracts. It's just so much
totally. And then you give them some random percentage of some tool that you own, and you're supposed to make sense of that. And you're like, 0.0172 is like worth $5 million, and they're like, what? This makes no sense.
Yeah, just look on Etherscan, you'll figure it out.
Yeah, and the way we came up with this this trick, as you call it, was really out of necessity. So when we first launched Origin Dollar, it was just rebasing everywhere, and then we put some funds on Uniswap, Uniswap V2, and it immediately broke. Like it just errored out every time we tried to swap. And then we looked at it and we're like, their code is expecting a set amount of units, and if it's a rebase, it messes up the math, and it just breaks, and it just errors out. Like it's really ugly in the way it breaks. And so when we were looking some more, and they have they accounted for this a little bit. So there's a sync function you can call on Uniswap, which will reset the cached value to whatever the actual amount of tokens there are. So we did that for a little while, and then we were like, oh, wait a minute, there's also Sushi Swap, and then there's all these other copies of Uniswap V2. It's been forked hundreds of times at this point. We can't actually have a whitelist for every single one of these AMMs and clones that are breaking, and who knows what else is going to break. And that's when we realized the simplest solution for us was to just turn off rebasing by default whenever OUSD is held by a smart contract. And so that was a sort of the easiest technical solution to make sure that OUSD could play nicely in DeFi without breaking stuff unexpectedly. And it was really a little bit of a side effect of that it came up with this interesting property where the capital that's held on Curve and Convex are essentially boosting the yields, the APY for everyone else. And so the people who are just holding OUSD in their wallet are still benefiting from the CRV and the CVXs being sold by the protocol, but they don't have to do any of the work to do the swapping or anything like that. And so one of the things that people often ask me, like, what's the price prediction for OUSD? What's the APY? What's it going to be? What are you going to do? And I'm like, it's entirely driven by macro. But what I can promise you is that we will always, 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 always deliver higher APY than what you would get if you just parked your money on Curve directly yourself. If you parked it in on Compound or Aave or any of these underlying strategies we have, because of this boosting mechanism that we have, right? That we can always get, will always be at least a little bit higher because of all the money that's sitting on smart contracts, and the people who are basically forfeiting their organic yield because of that.
And then obviously this is where the kind of the utility and the utilization of the stablecoin comes in, because you create this actually virtuous cycle, because people take OUSD, put it somewhere else, it pushes up the yield, more people come into the stablecoin, the yield goes down a little bit, they take this coin, they put it somewhere else, and it just keeps creating the positive momentum. And also from what I hear, sometimes there are special rewards for those who provide liquidity on Curve for OUSD.
Yeah, so we did this.
We did this. Your time to leak some alpha.
Yeah, so we did this very successfully. Towards the end of last year, we set aside 10 million OGN for a liquidity mining campaign for OUSD. And we were, no surprise, the power of incentives to drive outcomes. The circulating supply of OUSD went from $30 million to $300 million in, about 10 weeks or so. And so pretty powerful to watch that in action. And meanwhile, at Origin, we actually have two products. We have OUSD, the yield-bearing stablecoin. We also have an NFT platform that's done a lot of record-breaking NFT sales. Like we just did one with Paris Hilton. We did Blouse for $11.7 million. We did the SpaceX NFT drop with 70,000 NFTs that all went to charity, St. Jude Hospital and Cancer Research. We did the Charlie Bit Me NFT sale. So we've done a bunch of NFT stuff as well. And our community's always been a little bit confused by what is OGN and how does it tie to the NFT platform? How does it tie to what you're doing with Origin Dollar? And so recently we made the decision to launch a new token. And we're actually going to have separate tokens for our NFT platform, Origin Story, and Origin Dollar, which are yield-bearing stablecoin. So we've made that announcement, and we're going to be hopefully rolling out that new coin in May. And as we've been designing the token economics around this, one of the things that is really important to us is that the people who have been using OUSD have some stake in the new token, and that they're able to get some of the rewards for participating in Origin Dollar and rewarding the earliest believers in what we're doing. So we are looking into offering retroactive rewards to people who have been providing liquidity, such as yourself. And we do, think it's only appropriate that the people whose money is at play in OUSD are the people who actually are going to help govern that money as well. And so we're going to be rolling out VE token style economics for this new token. So OGV, and we're going to be airdropping it to OGN holders as well as people who are OUSD holders and liquidity providers. But we're going to have that VE token style model, so you'll be able to lock up your OGV for anywhere from 1 week to 4 years, get VE OGV in exchange, and then that will give you, the longer you lock up, the higher your economic power and voting power as well. And that way, the people who are making governance decisions for how the protocol is run and operated are made by people who have got most invested in long-term success for a protocol, which I think is really the brilliance of Curve's design. I think there's a better token model out there, at least that I've seen.
Nice. That's quite a lot of actionable alpha. So I'm sure a lot of people who will be watching this, they'll be very busy after they finish this.
Well, you've been dropping a fair amount yourself, sir.
Yeah, indeed. And it's pretty interesting. So, we've seen that there are a lot of these like curve wars, right? Where projects aim to accumulate the tokens of Curve. So it's probably reasonable to assume that, any V token has been pretty successful as a model. So it's reasonable to assume that, especially in this case, where you have this interesting dynamic where you're not just deciding what's good for the protocol, but you're also designing the mechanism and the balance between the stable coin and the pools around the stable coin. So it probably makes a lot of sense to actually have those who've been providing liquidity for a long time to be involved because they care a lot.
Yeah. Our core, when we think about the core users of Origin Dollar, is people like yourself. It's stablecoin farmers, and those people largely hang out on Curve. They provide liquidity on Curve and Convex probably more than anywhere else. So that is the audience that we want to continue to incentivize, to pay attention to what we're doing with Origin Dollar, and for people to understand the dynamics of it, why it's safe, why it's a good place to park their money. And we've talked a lot about sort of the Origin Dollar as an investment vehicle, but long term, our vision is really to have it as a superior stablecoin. There are two things that bothered me when we started Origin Dollar. One was all the pain points around yield farming that we already discussed. The other was just like how much money is sitting in Tether right now, not earning anything. Exactly. Your APY when you're holding Tether in your wallet is 0%. You're not earning anything on it. And our long-term vision for Origin Dollar is to make it so ubiquitous that you can actually start using it as a replacement for Tether, where you can actually settle your debts with it, send money to friends with it, and anywhere that you would use Tether today, you can swap in OUSD instead. And of course, to get there, we have to make Origin Dollar ubiquitous, and so that is it's going to take a long time for us to get there. There's a lot of work ahead, but the more that we can increase our circulating supply, the more integrations we can get. It becomes a little bit of a virtuous cycle where higher the TVL is, the easier it is for us to get other DeFi protocols to integrate us. It's easier for us to get centralized exchanges to support us. When they come in, it makes it easier for more capital come in, and it just becomes a virtuous cycle, like I said. So that's the direction we're heading in long term, and I really can't wait for the day when I take my paycheck in Origin Dollar, have it just automatically start earning the minute it hits my account, and we can go from there.
It's makes a lot of sense. And actually, personally, there was another reason why I got so excited about OUSD specifically, and it's more on, I guess, kind of fundamental ideological rather than anything else, because what are stable coins, right? They are basically digital dollars issued by either a company or a decentralized protocol, right? So from that perspective, you can argue it's a little bit similar to PayPal e-money. I mean, much more useful and much more productive, but still. So there's some level of innovation. But what excites me the most about crypto in general is that it's codifiable money. So I've been asking myself a question, like we're very DeFi native. Why is it the case that actually most of our stablecoin portfolio is dollar denominated? We're actually not even denominated dollar linked. Wouldn't it make more sense to have an asset which actually protects you from inflation? And then you can do it in two ways, right? Option number one is you try to, and there is some innovation happening right now around this. You can try to link your stablecoin to an inflation index, which is fine and it's great, but it's just very risky and complex. Or it can just be an asset that produces, the return for you, produces the yield, which makes it inflation resistant. And whether you're making more than inflation or less than inflation depends on how you calculate inflation. But obviously with 10, 12-ish% or higher, you're obviously exceeding inflation, and that's a structural thing, right? So why would you keep your savings in a stable coin that is based to the dollar? You should keep it in something that is actually a productive asset. And this is why, to me, this is like a 0-to-1 innovation. It sounds simple, but I'm sure it was very difficult to execute. I can imagine. But I think this is a huge differentiating factor, which is not to be understated.
Yeah, no, it is huge. I think inflation is more and more on people's minds.
Yeah.
Because we can feel it, right? We feel it
Yeah.
when we go to a restaurant, we order a meal. Feel it when you call an Uber and you're like, why $40 to go, 5 minutes? What is going on here?
Yeah.
And so it's very top of mind for everyone. And I think one of the things that I know a lot of people in who are holding OUSD are doing this. A lot of us are very long-term bullish on Ethereum and Bitcoin and other assets. But you can take out loans against those assets, and you don't have to have to talk to anyone, or take sign any paperwork or do anything. You can just go to Maker, lock up your Ethereum, mint a bunch of DAI, take that DAI to mint OUSD, or go deploy somewhere else in crypto. But no matter what inflation is, you only have to pay back the original amount.
Yeah.
Plus, whatever the fee is, the interest rate. And so that is another huge advantage as well, is that you can borrow against the assets you're going to hold, and as long as you can be in assets that are returning higher than the borrowing rate, that's another great way to turn those assets you're going to hold long term into productive assets.
Yeah, absolutely. Yeah, there's a lot of kind of stuff you can do to kind of optimize it, arbitrage it, and that sort of thing. And if that's when one of those just sits in your wallet, the UX is just so much nicer.
I appreciate you shilling OUSD so hard.
No, it's just
I do appreciate it.
No, it's really good stuff. But a question that I'm curious to ask you is, how are you thinking about the multi-chain strategy? Right. So obviously the world is becoming very cross-chain. Like, what are your preferences and what are your kind of dislikes, so to speak, in terms of other chains where you could potentially deploy this?
Yeah, well, we've started investigating it. It's something we will do. It's just a matter of when. And there's a number of questions we have to ask, and they're all quite tricky. So one of the things we really want from a principles level is we want Origin Dollar to be fungible. We want there to be one OUSD. We don't want to have multiple different flavors of it, a high risk version, low risk version. It's just OUSD is one thing. That'll be easier for us to make it ubiquitous, right? And it's easier to get one coin integrated than a dozen. And so when we think about Origin Dollar on different chains, the problem is they come with very different risk profiles. Because you're exposed to maybe a newer chain, bridges, wrapping. You have different, completely different underlying strategies than what we're using on Ethereum. And so then the question becomes, okay, so say we have a higher yielding but higher risk version of OUSD on another chain. Do we share the profits, but also the risks with everyone else on the different chains? And then how do you do that from a technical perspective? Not everything is a straight fork of compound and Aave curve. And so that means writing new smart contracts. We're taking on new smart contract risk. And sometimes they're the same contracts, but they're playing with different assets that are riskier.
Or oracles,
different oracles, different bridges, different things. And part of a realization that Origin has made us sort of not jump in right now is that we don't have enough team members to be paying close enough attention to multiple chains at the same time and managing that many different versions of our smart contracts. And so in the interests of keeping everyone safe, we don't want to spread ourselves too thin. We need to be paying attention in order to roll this out safely. But it will, we will get there. We want to get to the place where we can tap into the yields that are being generated on different chains, as well as just making it easier for people to access OUSD without having to pay the crazy gas costs that you have on the Ethereum network.
It's a valid point though, because we've seen various stable coins on various chains, and they're wrapped through various bridges, and you need to struggle. You quite struggle to understand those risks of specific bridges, especially with the bridges. It's very difficult to do.
Yeah. Do you have any chains that you're that you trust more than others right now, or where you're spending most of your time?
I'm a bit of an Ethereum boomer, I would say. So I feel most comfortable with Ethereum. Most of our portfolio is on Ethereum. And actually, I've been thinking why that is the case. Is it because we just feel Ethereum is safer? Yes, to a certain extent, but more importantly, we feel that real innovation is still, in our opinion, mostly happening on Ethereum.
Yeah.
So most of the teams that we kind of like very much are on the chain. We're seeing a lot of obviously other very good teams on other chains, but if you just look at the numbers, it feels that in DeFi specifically, the majority of new projects are still happening on Ethereum, and it's important to be part of that ecosystem.
Yeah, and incentives are such a big part of the alternate chains, right? When you see the crazy high yields, a lot of times they're quite short-lived because they're just someone's throwing out extra incentives, and that's also hard for us from a development perspective to write up the contracts and get them audited and feel good about them. By the time we get everything ready, the yield has probably moved on to some other chain, right? And it just keeps rotating around depending on who's offering the highest yields that week. And then when you go back to Ethereum, it's like, well, maybe we're missing out in the short term, but that's where everyone ends up.
Eventually, anyway.
Eventually.
We often find that we move some capital from Ethereum to another chain, but then eventually it finds its way back. So yeah, that's exactly what our experience has been.
Yeah. Well, this is really fun. Thank you for proposing we do this. We should do this more often. This was really awesome. Any final words, parting thoughts for anyone?
That's a tricky one. I would just it will sound very boring, but I would encourage people to think about risk a little bit more, because I think the degening days are pretty much over. The yields are much more normalized, which means you need to actually think about risk much more seriously. And I feel that we need to be growing up in line with our industry.
Yeah. Where can people go to learn more about RP7 and the work that you're doing?
Yeah, we have a Twitter account, so it's just RP7 Capital. We have a newsletter called the Financier 2.0, where we've been educating our friends about DeFi for a long time. And obviously our website, RP7.capital, so they can ping us anytime. We're always keen to meet new DeFi people and learn together with them.
Awesome. Well, thank you so much. This was a ton of fun.
Thanks for having me.
All right, take care.